Hello and welcome to the Investor Talk Show. I'm your host, Neil Peterson from Real Estate Investor, where we unpack insights, strategies, and real opportunities shaping South Africa's property and investment landscape. And today we're focusing on a sector that drives jobs, economic growth, and tangible value, property development. But let's face it, accessing funding for developments has become tougher than ever. We're seeing rising construction costs, stricter lending criteria, and risk-averse financiers have really made it challenging for even seasoned developers to get projects off the ground. To help unpack what smart funding really looks like in this environment, I'm joined by Friedrich Meisenholl. He's a regional investment manager at Business Partners in Cape Town. And Business Partners has long been one of South Africa's most respected alternative financiers, backing thousands of entrepreneurs and developers with tailored funding solutions that go beyond the traditional banking model. So, Friedrich, welcome to the Investor Talk Show. It's great to have you with us.
Thank you very much. Happy to be here this afternoon.
Fantastic, man. So, Friedrich, let's start by setting the scene. I mean, the property development sector has gone through major shifts, rising costs, tighter margins, and slower pre-sales. From your perspective, how's this changed the way developers are seeking finance?
Yeah, I must say the environment for a property developer, I think, is becoming more and more difficult. Rising cost, much more delays, and then obviously within certain areas, just the access to good opportunities are more and more scarce. I think for any property developer, speed is probably the most important thing. So any form of funding that can assist you to ensure that the speed of your project can be as quickly as possible. In any development, speed is money, and the sooner you can get it over the line, the better it is for all of the parties involved.
Okay, so are you finding that developers are more open to co-funding or blended finance structures than they were a few years ago?
Yeah, I think property developers by nature, if you are a property developer, you've always been flexible, right? You have to make it's you're like an entrepreneur. So if there's an opportunity, you have to be flexible and to see how you can make that opportunity come to fruition. So most definitely, where you can share some of the risk, share the expertise, open to co-finance, yes, that's definitely there. But it's always it is problematic because I mean, who shares the risk, who takes the majority of the risk, who gets the bulk of the reward. So it's usually a bit of a give and take scenario.
Okay, so when a developer approaches you, what are the first three things you look for to determine if that project is fundable?
Yeah, so I think as a start, usually to try to make an in-principle decision, you would want to see their own feasibility study. That will give you very good insights as to how much of their own homework have they done, have they considered all aspects and timelines. So their own feasibility study. Then the location for us is very important. And then I think thirdly, who is the entrepreneur, who's the developer, what's some of their background, what have they done, what is their experience. I think those three things on a high level basis usually can give you a fairly good indication. High level, is it something that we can consider or not?
Okay, great. So we see that also development funding carries a very different risk profile from income producing property. I mean, how does Business Partners manage and price that risk?
Um, I, I think for us, across all avenues of where we finance, if we have to break it down, for us, there's in any form of funding application, including property developments, there's three key areas: the financial risk, the business risk, and the entrepreneurial risk. The business risk, property development, where where is the opportunity? What's the area like? What's the growth in the area like? The demand? In what period of the property life cycle is the development? Then, if you look towards the entrepreneurial risk, who's the developer? What's his expertise? What's his background? Who's the people around him? His professional team, his management team, and then thirdly, the financial risk, right? So, if the development does not come into fruition, how much of your funding is at risk? So between those three risk components, you need to balance them out. If you've got low financial risk, you can take a bit more risk on the business side or on a potentially slightly less experienced developer. If you've got high financial risk, you definitely want to make sure it's a experienced developer in a very good area. So I think for us at the end of the day is to try and balance those key risk areas. And then obviously if the risk is higher, then the appetite for the type of return that you would like to obtain must also be higher.
Okay. So can you maybe outline the types of projects you typically fund? I mean, in terms of size, ticket range, and the structure of the deal.
Yeah. Um, Good question. So I think for us, maybe to start off with, our funding cap is at 50 million. So typically, if you look at 50 million residential developments, most probably if you don't already own the land, it will probably only be to finance the top structures. If it is for land acquisition and some infrastructure cost, then most probably it would have to be a development that's being sold on a um, plot and land basis. I think then for us, which is also important when it comes to residential developments, ideally for us, it should be to construct and sell, not to hold. On the commercial and on the retail side, we would be willing to take a view on construct and hold. There we can even play a bit of an equity participation role as well. Yeah, and then typically we like with an ideal structure, you try and keep the interest component as low as possible, because that also has an impact on the cost of funding required, especially if it's over an extended period of time. So keep the interest rate as low as possible, and then rather see if you can't make your return from almost, let's say, call it a profit sharing or a fee on each unit being sold. That mitigates the risk if a project runs a bit longer, and it also helps the developer that the financier is also sharing in some of the risk, that you only get your money once the units are being sold.
Okay. So what proportion of the total development cost does business partners typically finance, and what equity contribution do you expect from the developer?
I think that makes us quite unique in the market. We are quite comfortable to do 100% of the development funding. That can even include the land acquisition cost. But in that scenario, um, that would, as mentioned earlier, that would increase your financial risk, right? So to mitigate that, ideally in that scenario, we would look towards some outside collateral that can compensate for that risk. So in an ideal environment, that would be a property developer that potentially has some assets in his balance sheet, but the cash flow at that point in time is not available. So rather than going to liquidate some of his assets to put down as an equity contribution, rather to say, okay, if the numbers work, if the opportunity makes sense, we'll provide 100% funding, but in exchange for that, we would also need to have a look at outside collateral.
Okay, great. So walk us maybe through the ideal development funding process. I mean, from the first conversation to disbursement. I mean, what do the smoothest deals have in common?
Yeah, property development, it's never a smooth ride. It's unfortunately never a smooth ride because I think everybody is so reliant on each other, right? And reliant on third parties and reliant on the municipality. And so it's never a smooth ride. I think for us, a few key things. If you already own the land, that potentially means you've already been able to do a lot of the groundwork from a approval perspective from the municipality, which helps a lot. So that's one thing. I think another thing that we see is if it's a property developer that either has very good in-house expertise within his business, or that he's got a good relationship with um, professionals and he's got a good relationship with whoever's going to be the main contractor, and how to manage them. So the project management side is usually very, very key. And then I also think it should always be a bit of a give and take, even from our side as a financier, is to see on each, because no development is exactly the same. So also to specifically to identify on each property development, what are the specific needs? Where do we anticipate will there be either delays or pitfalls that we try and plan for the unexpected? So if you can have that relationship with the developer upfront, it really helps a lot. And then during the course of the project is to have very good communication. So we prefer to be at the site meetings, know what's happening. Even though we don't get actively involved, you have to stay close and then to be able to see where we can assist or help with what is required.
Excellent. So let's talk a little bit about some recent transactions and, maybe some of the lessons you've learned. I mean, without disclosing, confidential details, can you maybe share an example of a recent property development funding transaction that really stood out for you?
Yeah, I must say we've done quite a few in the last 2 to 3 years, especially here in Cape Town. There's a lot of demand. I think for me, one specific one that stands out is where we've had the opportunity to actually do multiple projects with one single client. And it started out where um, they were had quite a few opportunities on hand where they acquired, so they use a lot of their available cash to acquire good pieces of vacant land. Unfortunately, their planning of in ideal environment, each would have been developed in sequence. The one they actually thought they would start with first is the one they still haven't been able to start with because they had a lot of pushback from the neighbors and getting approval. So I think at the end of the day, where we started with them, we started small. They said, "Look, we've got quite a few opportunities, but none of them can happen right now. But we need someone to uh, assist us. We've identified a few vacant stands. We're actually full on property developers, but we need to do some speculative houses to keep the project teams and the construction teams going. So we started with that. From that, they obviously get to know us. We get to know them. Then we started the next opportunity. They came to us. They were open-minded enough to say it was a sectional title scheme development, but we said because of the size thereof, for us, we would be much comfortable if we can potentially split it up in two phases. Being able to do the first phase again, it just mitigates our risk. So on the exposure side, so that meant we could be a bit more flexible on some of the other requirements pertaining, let's say, for example, towards if we can do it in phases, we don't have to start with pre-sale. So let's just do phase one. Um, there's no requirement for pre-sales. That obviously gave us a lot of comfort, and that could roll into phase two. They were able to come to us and say, let's get phase two funding already approved. You know, business partners, you know how we operate, you know can we get the approval upfront. So we were able to do a bit of a dovetail. As soon as the first phase was done, we could immediately give them access to funding to start with phase two. So I think for us, that was well, yeah, that was for us a very good example of if you're able to build some good relationship, get to know each other. Even if you only start small, it doesn't mean there won't be future opportunities.
Okay, great. So let's talk a little bit about the role of partnerships and co-funders. I mean, collaboration between financiers, municipalities, and private investors is definitely becoming more common. How open is business partners to working, alongside other funders or joint or syndicated deals?
Mm. Very much so. So I think in this day and age, you have to be open-minded. And if you are going to do that, especially with co-funding, um, to have the open and frank conversations up front, to make sure all interests are aligned. And if you can get that match, most most definitely. And then without saying, the role of the municipality is very important. The professional teams are very important. So with that also, you want to make sure that there's a good relationship and good open communication surrounding that.
Okay, excellent. So looking ahead, I mean, as we head into 2026, where do you see the biggest funding gaps or growth opportunities in South Africa's development landscape? I mean, is it affordable housing, mixed use, industrial, or student accommodation? Where are the areas that you're seeing where the opportunities lie?
Mm. I think definitely from our side, we've seen um, a spike in all of the asset classes, specifically in key areas. So I wouldn't necessarily say only in a key asset. Like I mentioned, residential development, I think is still strong. The need for good quality student accommodation is still very strong. There's still a massive shortage of beds for students across the whole of South Africa. Um, in industrial opportunities, again, we see a lot of demand for that. So I think if you stay close to the metros, in all of those asset classes, there will be quite a few opportunities. Um, Cost of land, especially in Cape Town, remains a big challenge. So to find the opportunities is not easy, but yeah, still a lot of demand, and if you're at the right place at the right time, still a lot of opportunities.
Okay, great. So finally, Frederick, I mean, what advice would you give to emerging developers trying to build credibility and access funding in this climate right now?
Yeah, I think that's always a difficult one, right? So you can get someone that's got the passion and the skills, and typically with most financiers, you want to see a bit of a track record, maybe a bit of a balance sheet, some assets. And if it's not there, my advice would usually be is to start small. Start small, be patient, um, and because if you start small, someone would potentially be willing to take a bit more risk if it's smaller ticket sizes. And over time, if you build up the relationship, you are able to increase those ticket sizes, which would mitigate that risk. So again, just going back to that three pillars for us on the business risk or the financial risk or the entrepreneurial risk. So if you are fairly new to the game, there is not a lot of assets to back the opportunity. Start small, because then a potential financier like us can take that risk on someone that doesn't have that much experience, and then you can build from there.
Excellent. Friedrich Meisenholl, Regional Investment Manager of Business Partners Western Cape, is incredibly insightful. Thank you for your time and for sharing such practical guidance to the investors out there. And it's clear that business partners isn't just about finance, it's about partnership, mentorship, and making viable projects happen in a challenging environment. To our viewers and listeners, if you're a property developer entrepreneur looking for smart capital and guidance to take it to the next project going forward, you just visit businesspartners.co.za or reach out directly to us, and we'll ensure that Business Partners gets in touch with you to learn more about their property development funding options. So don't forget to subscribe to rei.co.za and to our Investor Talk interview platforms. I'm Neil Peterson. This has been another episode of Investor Talk Show. Thank you once again, Friedrich. And so come and join us next time where we turn property knowledge into power. See you next time.